Hey guys, I'm Aaron Hilligas. I'm with Howard Hanna Bardale Realty in Bedford, Pennsylvania. Feedback from my first video seemed pretty positive, so we're here back for part number 2. Financing is one of the most, if not the most, confusing parts of buying a home. There's so many different kinds of loans to choose from, and one size does not fit all. Make sure to do your homework on the type of loan you plan to receive, your lender, and if you're able to afford the amount that you decide to borrow. My info will be kept up on the left-hand corner. First, a quick disclaimer. I am not a financial advisor. All information found here, including any ideas, opinions, views, forecasts, commentaries, suggestions expressed or implied herein, are for informational, entertainment, or educational purposes only and should not be construed as personal investment advice. While information provided is believed to be accurate, it may include errors or inaccuracies. I will not and cannot be held liable for any actions you take as a result of anything you read or hear here. All right, let's get right into it. You got a fixed rate or an adjustable rate. The fixed rate is by far the most common choice among all home buyers. Some pros: when you're pre-qualified, you're locked in at that certain interest rate that your lender gives you for the entire length of the loan. You may pay it off faster by making extra payments, in many cases without being penalized for early payments or what's called a prepayment penalty. They're by far easier to understand than an adjustable rate, and you're protected from rising rates. Chances are interest rates will rise again in the near future, so a fixed rate mortgage is ideal for this time in the current housing market. Some cons is that you may be stuck with a high interest rate. You do have the chance to refinance this loan in the future. Onto the adjustable rate. With this kind of loan, your interest rate fluctuates with the entire market, making your payments different. Uh, One pro is that it's flexible if you're expecting rates to drop soon. Uh, but the cons is just about everything else. Payments can fluctuate throughout the entire length of the loan. Like I said, there can be many complex fees and rules for obtaining these type of loans. And in most cases, if you pay too early, you will be hit with a prepayment penalty. So the bottom line here is, while adjustable rate mortgages are not ideal for everyone, they can be useful for people who don't plan on owning the home for the entire length of the loan, or people who think interest rates will drop in the near future. Today's market is perfect for fixed rates. This is a time with those with adjustable rate mortgages are refinancing and locking in these low rates. So my suggestion to you is to save yourself from future anxiety and frustration and just go with a fixed rate mortgage. All right, types of financing. You got cash. It's quick and easy. Inspections and appraisals are up to you as the buyer. They're not necessary. You have the conventional loans, which are backed by a private institution. These offers are typically the next best thing to a cash offer. Then you have your government issued, the FHA, the USDA, the VA loans. They're all backed and secured by the federal government, so they typically come along with some required inspections and appraisals. Over to the conventional loan. This typically requires a DTI, or a debt to income ratio, of under 43%. If you have no idea what you're talking about, after this video, head on over to my first video. We go over the vocabulary and explain what this means. Some pros is that there's more payment options, such as the term and the down payment. They're typically fixed rates, so you can secure a lower interest rate with a better credit score. Some cons may be that typically your credit must be above a 620, but in some cases they require it to be higher. And some may have a little stricter requirements even further than that. This institution typically dives a little deeper into your credit history and your current financial situation. Over to the FHA loans. These are issued by the Federal Housing Administration. They can be used to buy anywhere from a single family home to a 2 to 4 unit home, a condo, or a manufactured home. The pros of these is most of the time they don't require such a high credit score or a down payment, or a high down payment, I should say. Some cons may be that there may be a little higher closing costs than a conventional loan. People with credit scores between 500 and 579 sometimes require a higher down payment. And also, 2 mortgage insurance premium payments are required. One is at the start of the term, and the other is paid annually for the entire life of the loan. On to some different types of FHA loan. You got your basic home mortgage, or a 203B as they call it, a 203K rehab mortgage, construction to permanent loan, Title I property improvement loan, and an energy efficient mortgage. Over to the VA loans. So these are guaranteed by the Department of Veteran Affairs, and only qualified U.S. veterans and some of their surviving spouses can qualify for this loan. It was originally created by the GI Bill of Rights in 1944 to help veterans return to a normal life after World War II. Some pros of this type of loan is that oftentimes no down payment or mortgage insurance is required, and sometimes your closing costs can be even lower as well. Some cons may be that not all properties are eligible for a VA loan since they do need inspected and appraised. It can only be used on your primary residence. So even though you can obtain another one in the future, your first one must be paid off. So basically, you can only have one VA loan at a time. Typically, there's a funding fee of between 1.4 to 3.6% of the purchase price, and this is set by the federal government. And this helps to cover the cost if it would happen to be foreclosed or the buyer defaults. On to some different types of VA loans. You got your VA purchase mortgage, VA cash out refinance, interest rate reduction refinance loan, rehab and renovation loans, and a Native American direct loan. And finally, over to the USDA loan. These typically require no down payment for certain rural home buyers. This comes from the U.S. Department of Agriculture. Its goal is to improve the economy and quality of life in rural America. Some pros may be that generally they have low interest rates. These depend on location and income, not necessarily of you having a certain job. And some may even qualify for loans and grants to renovate the home. Some cons may be that it's subject to mortgage insurance premium if your down payment is low or zero, and not everyone is able to qualify for this type of loan. Thank you guys for watching part 2 of my first time homebuyer webinar series. I hope I'm able to at least help one person make this process just a little bit easier. If you have any questions, feel free to contact me at any time. You know where to find my contact information. And if not, you can head on over to my Facebook page. It'll be facebook.com/Aaron Hillegass, HHBR. Make sure you head over there, leave a like on my video and on my page, and stay up to date with what I got going on. All right, thank you guys.